in my mind, macro has completely changed. It has flipped. Okay. And again, this is not political. You may like Trump, you may hate Trump. It's not about that. It's what they're doing and what they want to do. Okay. And I agree on the left side. The right side is what's happening though. So to sum it all up, what is the new administration talking? Right? Their talking points is all about we want to lower inflation. The last couple of numbers were okay. How do we lower inflation? We slow the economy down. Only way. We slow consumer spending down. Well, if we slow consumer spending down, the economy automatically going to slow down because 80% of GDP is consumer spending. 2, lower oil prices. What did he say during the campaign? Right? Drill, baby, drill. Well, it's going to happen. They're going to lower oil prices, which is affecting all of us because which one of us doesn't buy, gas, heating oil, or natural gas, all that stuff, right? That's going to lower inflation. Well, if those first two things happen, lower interest rates will follow. If inflation goes down, economy slows down, lower oil prices follow, lower interest rates will follow, right? And the fourth one is what Doge is trying to do, less deficit spending. Well, let's control the deficits. Because if you're taking in, look, our US government takes in $4 trillion in revenue, the Treasury does. We spend 6 trillion every year, or 6.5 trillion. We can't live like that. If that was my household, I'd be broke, right? I don't have the power to print money. Okay, less deficit spending, sure. Reduce US trade deficit. This one is a touchy-feely one because the only way that happens is by these supposedly, these tariffs that every day there's a comment. Oh, 50%. Oh, no, I'm taking it back. Oh, 25% here, 50%. Like if you listen to them, market's moving up and down, but every time, Trump says tariff, and then I can see the sell-off happening. And last one, less government inefficiency, so more government efficiency. All of these can be obtained and are a byproduct of economic weakness. Well, yeah, all of these will happen. All of this will happen if we go into recession automatically. So, and as we notice on the right-hand screenshot, let's look at the first 4 years of Trump, what the S&P 500 has done. And let's look at the first month and a half, couple of months, right? All right. So comparison Trump 1.0 versus Trump 2.0. So this picture is telling you, the graph is telling you that it's completely different than what was happening until COVID hit in his first term, Trump 1.0. So the green line is Trump 1.0. The red line, and that's the S&P 500, or the return on the market. And that's where we are. Okay. I'll answer all the questions when I'm finished. So in the Trump's first term, S&P 500 was up 5%. Okay. All right. This is the first 100 days or so. Okay. It's currently down 8% since January 20th. Right. And there has been drawdowns during the first presidency, first term, but nothing like it. I mean, we are selling off hard because markets taking a hold of what they're talking in Washington. Yes, we need lower inflation. Yes, we need lower oil prices. We need lower interest rates. We need less deficit spend. All of this can happen if the economy goes in a recession. Otherwise, it's not going to happen because I don't think Doge is going to be able to find enough waste, fraud, and inefficiencies to reduce that 37 trillion in debt. Okay. And there's definitely a shift. But as I said in the first topic, on the first segment, short-term pain for long-term gain. That's the talk in Washington. And it's pretty clear. I mean, first 1.0 Trump, green line, 2.0 Trump, for so far so good. But if I'm still doing this in a couple of years or 3 years, and then let's see where we end up, right? So the important thing for me is to understand the macro. Important thing for me is to figure out all of this that's happening and be cognizant of the facts put the picture together and invest and trade accordingly. And that's what I'm going to do. And I'll keep the channel going, you know, as long as I can, because I have other obligations, as some of you know. To me, the important thing is keep cash. Always keep cash. When the market gets this volatile, when VIX is at 30, 25%, or 25, and I'm looking at the implied vol, all the options, index options, short-term, long-term, 30%, that's double the average. You need to be very careful with directional bets, right? If you do directional bets and you get the IV crush, implied volatility crush, and which some of the members learned the last couple, 3 days, is not a fun thing to be in.